Hi folks, welcome to this video on fair value through OCI investments. You remember these are long-term investments and we add transaction costs or brokerage costs into the value of the investment account. So we refer to these costs as being capitalized costs. In our example, the company has fair value through OCI investments in the shares of other companies. One company is Nirmala, one company that they have shares in is on Oksana, and the other third company they have shares in is WTA. So the first thing we need to do is, assuming these are fair value through OCI investments, we have to record those investments on our books at the different times that they buy them. So because we're recording a purchase and they're considered to be fair value through OCI investments, we have to add the brokerage costs, which the question tells us to buy the Nirmala shares is $19.80. To buy the Oksana shares is $33.70, and to buy the WTA shares, the brokerage or transaction costs are $29.10. We're going to add this to the market value of the shares that we're buying, and we're buying 9,000 Nirmala at $33.50, 5,000 Oksana at $52 a share, and 7,000 WTA at $26.50 a share. So again, these amounts in here, the $33.50, 52, and $26.50, these are the market values, right? So because we're buying them in the market. So now we're going to multiply it by the number of shares, add in the brokerage because that's our rule. We add the transaction costs, and we're going to book the Nirmala shares, our purchase of those shares, as a fair value through OCI investment on January 15th as a debit to that investment account and a credit to cash. So that's what it's costing us to buy the shares, and that's what we capitalize as full costs into that investment account. On April the 1st, that's when we bought the Oksana shares, and the total cost including the brokerage is $263,370. So again, we debit the fair value through OCI investment and credit cash, and then the WTA shares, we paid $29.10 brokerage plus the market value of per share at $26.50 times the number of shares we bought. So the total capitalized cost of all the shares is $188,410. So now that we've got all these shares journalized, their purchases journalized, now we have to take into account one other thing that happened. During the year, of those 9,000 Nirmala shares, we sold 3,000 shares. That happened on May the 20th, 2017. Because of that, there's a specific way we have to treat the sale of any fair value through OCI investment shares. 3 steps we have to follow. The first thing we have to do is we have to adjust the investment account for the shares that we sold to the market value net of any transaction costs. So we have to adjust this investment account upwards or downwards based on what we paid or what we got when we sold them, right? Net of brokerage. Well, guess what? If we're selling, we would be selling those investments, or they would be worth on the market $35 a share, right? So we would have to adjust the shares, just the 3,000 we're selling, not the other 6,000, because we're only updating the investment account for the shares that we sold. We're going to adjust the investment account based on the value of the shares that we're selling. What's their value on May the 20th? Their value on May the 20th is $35 a share. That means the 3,000 shares that we're selling are really valued at $105,000 now. But don't forget, when we capitalized or debited the fair value through OCI investments when we bought the shares, it stands to reason that when we're calculating any adjustment to that share account on sale, we also have to account for brokerage and deduct any brokerage fees from that same investment account. So if we deduct the brokerage fee to sell those 3,000 shares, we know that we would net out or get $102,150 for those shares. But we want to adjust it for not just the market value, we want it to be net of the transaction cost at the sale date. Well, in order to determine whether that fair value through OCI investment account is going to go up or down, we also need to consider if they're worth $102,150 net of commission, how much are we booking them at to record a gain or a loss? Well, we know that they're worth at net $102,150, but we've got them booked at $101,160. How do we know? Because we know 9,000 shares were booked at $303,480. That included commission. So 3,000 of those shares would be coming off our books at 1/3 or 3/9 of 303,480. So we'd be removing those 3,000 from our current investment account at 101,160. So the idea here is what? The difference between what we can get them for net of brokerage on the market and what we've got them booked at is $990. So we need to increase our investments to their current market value net of the transaction costs at the sale date. This is already on our books, but we're saying we can net 102,150 net of the commission. So we're going to adjust the fair value through OCI account upwards by $990 and book our unrealized gain or loss, and because it's a credit, it's a gain, into OCI. So that's the first adjustment we're making to our OCI account. And don't forget that OCI account for unrealized gains or losses, that account is in our statement of comprehensive income. Now, what's the second step? Now that we've updated the fair value through OCI investment, we updated it from 101,160 to its market value net of commission, which is 102,150. So once we post this entry, they're sitting in our books now at 102,150. Now the next thing is to sell them. So we're going to get 102,150 in cash at net for them. Why? Because we sold them for $35 a share and we paid $28.50 brokerage to sell them. So now when we sell the investment, we're going to get cash of 102,150 and take them off our books at 102,150. So remember, this adjustment that we made for $990 brought them up to 102,150. That was the objective of the entry in the first step. The second step removes them at that value. So that's why we're crediting the fair value through OCI investment for 102,150 and we're debiting cash. The next thing we need to do in step 3 is to reclassify any cumulative unrealized gain or loss, but in this case we only have a gain, but I'll put it in there anyway, loss, because it could be in some cases a loss. Cumulative unrealized gain or loss through to retained earnings. So we're reclassifying it to retained earnings since in our question it's without recycling or no recycling. All right, so now what do? Well, the cumulative unrealized gain or loss on these 3,000 Normalis shares. So don't forget, you're only processing or doing these 3 steps on the shares that you're selling. You're selling 3,000 of the 9,000 Normalis shares. So we need to take any cumulative unrealized gains or losses, anything that's cumulative, we have to take and reclassify it or remove it from OCI and reclassify it into retained earnings. So how do we do that? Go back and look cumulatively, what have we booked into OCI cumulatively, period over period for these investments? Well, don't forget we only bought the investments in the current year, and we're selling those shares in the current year. So the only time we ever booked an unrealized gain or a loss on the 3,000 shares we're selling is in step 1. So this is what's going to get reclassified or recycled, reclassified into retained earnings. So therefore, we're going to debit that unrealized gain or loss in OCI for $990, and we're going to credit retained earnings. And again, I've made the point here to say, note that because this is the first year that the company had fair value through OCI investments, on a cumulative basis, we haven't booked any unrealized gains or losses on any of these shares. Not until this year when we did our step 1. Okay, there was nothing else we did in previous periods. So we've got these unrealized gains or losses, and in our case it was a gain because you can see it was a credit, right? A gain, it was a credit. Now we have to debit it to zero it out because we're running that gain or loss now through retained earnings at the year end, or at the time that we're selling the shares, which in our case is May 20th. All right, so now this is important because this is the amount when we do our statement of comprehensive income we're going to reclassify into retained earnings. And once we do the statement of comprehensive income, a partial statement, we'll show you how this looks. Now, the last adjustment we're going to make is at the year end. So at the year end, notice I've got the adjustment here, but what's more important is the work that I did to get it. Notice that if we're going to adjust the investments from the fair value that we have them sitting on our books at now, which is their carrying amount, to the fair value at December 31st, 2017, we're going to have to calculate on a portfolio basis, do we have a net unrealized gain or loss on these shares? So now we're only going to look at the carrying amount for 6,000 Nirmala shares, not 9,000, because don't forget on May 20th we sold 3,000 of the 9,000. Well, those 6,000 shares would be valued at what? 202,320. How do we know? Well, don't forget, 9,000 were valued at 303,480. We adjusted 3,000 of those shares upwards in step 1 when we revalued them upwards to their market value net of brokerage, because don't forget those were the 3,000 shares we were selling. So we did book that transaction in step 1 right here, right? So we increased the fair value through OCI investment portfolio by 990, but don't forget we also reduced it in step 2 by 102.50. So if you track that all through, you're going to get 202,320. Some students would say, well, I know that the full portfolio of 9,000 shares, I booked it back in January, was 303,480, but that was for 9,000. For 6,000, it would be 6 over 9 times that, and that would also get you 202,320. The fair value of those 6,000 shares is 180, so we have an unrealized loss of 22,320. The Oxana shares are already sitting on our books at our purchase price. We had no reason to revalue them throughout the year. We're doing that now at the end of the year. So they're still sitting at our books at the price we bought them for. And you can see up here, that's 263,370 back on April the 1st. We compare that to their fair value now, which is 275. We've got an unrealized gain of 11,630. The WTA shares, they're sitting on our books at the purchase date, which was in September, I believe. If we go back here, yep, September the 10th, we booked the WTA shares at 188,410. And now their fair value is 196, so we have an unrealized gain there of 75.90. So when we add up all the carrying amounts, which is 654,100, and compare to the total fair value, which is 651, we have an unrealized loss of 3,100. So that unrealized loss has to be booked based on our rules, because they're fair value through OCI investments. That holding or unrealized loss of 3,100 does not go into net income. It goes into other comprehensive income, which again is on your statement of comprehensive income. So far this year, what have we done? We've debited unrealized gain or loss on OCI investments for 3,100, and we've also credited them in step 1 for 990. So that's what went into OCI this year. Of the amount that went in, we reclassified 900 out. So now you might get the idea as to why I've color-coded these a little bit. The unrealized gain or loss credit went into your OCI account in the statement of comprehensive income, along with your year-end adjustment. We reclassified out of it 990, which we did from our step 3. So we reclassified some of that 3,100 plus the 990 out of the unrealized gain or loss through OCI account on the statement of comprehensive income and into retained earnings. So I've got that in blue to indicate it's going to be a reclassification. So you'll notice here, this is a debit, so it's a loss, and this is a credit, so it's a gain. So when we net them out, we're going to have a net loss, a net unrealized loss through OCI for $2,110. So how do I get that? Let's have a look at the statements and see. All right, let's have a look at the statements. If you look at the statements here, on the statement of comprehensive income, we know that's made up of net income plus OCI. So just to give you some numbers, I've decided that I would assume net income of $100,000. That's not in the question, I just made it up. How much did I book into OCI with unrealized gains and losses for 2017? That's my $2,110 loss. How do I know it? So I put the loss in brackets. That's just how I did it. How do I know that's the case? Because don't forget, at the year end, we had a $3,100 unrealized loss, and that got netted out against the step 1 unrealized gain when we adjusted the portfolio of shares being sold, which were the 3,000 shares to their market value net of brokerage. That's where we got the 990. So at net, what went into OCI is an unrealized loss, hence the bracket of 2110, and we're going to deduct from it any amount that we recycled into retained earnings or reclassified into retained earnings. So how much did we reclassify? Well, if you go to step 3, that's the amount in blue. It was 990. So we're reclassifying or removing the gain, the $990 gain that we booked in step 1. We're reclassifying it out of OCI and putting it into retained earnings. So negative 2110 minus a positive 990, because this was a gain, okay, that we had originally booked that we're recycling, right, or reclassifying to retained earnings. That's what we did in step 3. That's going to give us negative 3,100. So sometimes the math is a little bit challenging for students. So what I'm going to do here, I'm just going to pull up another little Word document just to make sure you guys are okay. You got negative 2110, right, less 990 that you're reclassifying. This is going to be negative 3,100, right? That's a mathematical thing. Negative 2110 minus or less the gain that you're reclassifying. It's not a loss, it's a gain you're reclassifying, is going to give you negative 3,100. So now, with that in mind, this is the amount that you're going to adjust your AOCI for in the shareholders' equity section, because that's the amount of net OCI that you have for this period, right? It's negative 3,100. So it's going to go into your AOCI account to reduce it or debit it, right? So now what will you have? You'll have comprehensive income of $96,900. On the statement of financial position, what will you have? Well, we said earlier that this would go to AOCI. So don't forget, because this is the first year that they've held fair value through OCI investments, they didn't have any balance in AOCI before this negative $3,100 amount or $3,100 debit into AOCI. So if you look at it from a T account perspective, we started with 0 because don't forget, before 2017 we never had any AOCI investments. So we started off with nothing in AOCI, and then we put this debit in there, right? This is going to AOCI. It's a negative amount, so it's a debit. So we wind up with a net debit of $3,100, and it's this amount, the final balance, which is on our statement, of financial position in the shareholders' equity section, and in the long-term investment section, we've got our fair value through OCI investments, the equity investments, at $651, which is the market value to which we adjusted them to when we made this journal entry. I just made a comment here that under IFRS 9, it doesn't support recycling through net income for the fair value through OCI equity or share investments. The gain is realized on those Normalis shares sold, and that would be transferred directly to retained earnings when we reclassify it, and that's our step 3 adjustment. So I hope you found this video helpful in helping you to understand some of the workings of fair value through OCI investments.